Hello world, my name is Elvin and I've been trading Bitcoin for the past 4 years or so. I first heard about Bitcoin in April 2013 when there was some media attention surrounding the Cyprus financial collapse. Like most people, I dismissed it the first time around, but I finally got around to buying my first Bitcoin in August 2013 and I never looked back since. Today, I want to share with you a little bit of my experience trading crypto for the past years and share some tips that I feel are more important than just charts and indicators and hopefully help you shorten your learning curve. Trading is not easy, so it is important that you arm yourself with the right trading techniques and price analysis frameworks so as to improve your accuracy, efficiency, and profitability. It is a marathon, not a sprint. Trading requires the right mixture of knowledge, discipline, and risk management. I feel that it is crucial for you to find a system that works and is suitable to your style. If trading is new to you, I highly encourage you to take at least the first 3 to 5 years to find a footing in the market before considering quitting school or your job to become a full-time trader. Because the truth is, trading as a hobby versus trading as a job and having to pay rent and expenses on top of that is very, very different. So let's take a step back and consider what's the one common thing between all markets. It is nothing but the people, right? So the textbook interpretation of price says that it is the representation of value that market participants are willing to pay for a stock or commodity. We put those two together. My interpretation of price is that it is the collective representation of emotions and behavior of these market participants. Therefore, by this logic, I think it's important that you learn more about human emotions and market psychology if you want to better understand the rules of this game. So what does it mean to make a good trade? I think it's an art of finding a good balance between price, direction, and timing. If you only look at the price and if you only look at the price and buy something that's relatively cheap, let's say around here, without knowing that you're in a bear trend, you're going to have a really bad time and when you take a beating as price continues to slide another 50-60% from your buy price. But if you got the direction right and you buy in an uptrend, if you have the tenacity to hold for say about 1 to 2 years, you'll be rewarded with a really sizable profit at the end, right? But if you also consider a good timing into your trade, you could buy something around here at a higher price but with more confirmation of the uptrend, and you only have to hold it for a shorter period, say 3 to 6 months before the parabolic starts to kick in, right? You see, this is why I think it's important to consider all three factors if you want to make a good trade. There is no right or wrong way to do it here. The key idea is to seek a balance that suits your trading style. So there are many different schools of thought when it comes to technical and fundamental analysis. Personally, I would say that it is 95% TA and only 5% FA. How most people use this is they use the fundamentals to filter out the stocks, to remove the weaker ones, and you use technicals to zoom in and find a good price and timing to buy the stock, right? First of all, there's FA does not consider two important things for a trade. First is timing, and the second is it does not incorporate stop losses into your strategy. Why do I say that? In fundamentals, when your fundamentals of the company stays the same, but as price continues to slide against your position, FA says to add on to your position, right? So it does not consider that the market might be in a downtrend, and it does not have stop loss in place for you. So that's very, very dangerous for a trading strategy. That said, there are also people who go way overboard with technical analysis. So my next tip would be to keep it simple. When you look at a chart, the main thing you want to look at is only just price and volume. Indicators should only be used as a supplement or a guide to to help you determine whether your initial analysis was right or wrong. It is not about how many indicators you use or how many lines you draw. Knowing how and when to use them is the key, and usually simple works best. From what I've gathered over my years of trading, technical analysis is not only about charts, indicators, and patterns. There are even more important concepts like market structure, emotional crash cycles, and trader psychology, and I'll go through them in a bit. When you look at a chart, you should segregate the different sections of price action and classify them into structures of accumulation, markup, distribution, and markdown. If you want to get into it in more detail, go and read some articles and watch some videos about finding support and resistances, how to trade with market structure, and if you want to go into more advanced technical analysis, you could look at the Wyckoff method and Elliott wave theory. Trading is a zero-sum game. What that simply means is that for every winner, there has to be a loser. So along these same lines, the more people know about a piece of information, the less valuable it becomes, right? And similarly, if a majority were to have the same opinion about a market, it might be wise to take the opposite position. This may be a bit confusing to some of you at the start, but I'll go through a few examples to make it clearer. Before we do that, this is probably the most common question asked by people. Is Bitcoin a bubble? Without actually answering that question directly, let's take a step back. You can see the obvious trend that there's a consistency in this boom and bust cycles, and with each cycle there is an expansion of adoption and price. We have been through about 5 or 6 of these cycles so far, and each one is characterized by exuberant buying into a parabolic, followed by a long bear trend where price bleeds and grinds down about 90% from the top. This prevalent pattern is called the market or emotional crash cycle. I believe this is the single most important philosophy in trading, right? Because it happens across all markets and all time frames. The price goes up, the price goes down, and this pattern just repeats itself over and over and over again in different time scales and magnitudes. And that's it. Let's look at some examples. Personally, when I hear some comments like something is going to become a store of value, or this will never crash, or I just need to hold this for 1 or 2 years and it's going to make me rich, when I hear stuff like that, I become wary and I take a step back. I think it's a sign of euphoria and complacency, and to me nothing screams sell more than that. So what do you think about this? Nothing? Speechless, right? So was I when I first saw this. You might find it ridiculous, but these people are dead serious about their attachment to their investments. Surprisingly, this is a relatively accurate indicator to call tops in the market because it represents thrill or euphoria in the market participants. When you create your own trading plan and your trading strategy, it should be based on rules and technical analysis setups. With this, you'll be able to remove some of the emotions out of the game, but at the same time, it's also important to still have some emotional control, to be able to take a step back when you're trading to analyze the current psychological state of the market. Are people talking about how much money they have made, about buying Lambos and etc.? Maybe it's time to sell. Or is there silence in the community? Are people in fear? Maybe it's time to buy. You should also include some indirect factors in your trading strategy, such as penning down your personal goals, maintaining a trade journal so that you can reflect on your bad and your good trades, and also keep an exercise or your diet regime so that you can keep your mind sharp. When it comes to risk management, this is probably the most undervalued component of trading, and consequently is also why most new traders continue to blow up their accounts. This could include things like exchange risk of having the exchange getting hacked, a market risk such as the potential chain split of Bitcoin in 1st August, your risk appetite, and even down to how you manage risks in your trade. In terms of portfolio management, it will include things like how would you split your Bitcoin portfolio into altcoins, right? How would you split between the alts? Generally, by fundamental analysis, you can easily eliminate about 50 to 80% of the projects out there. Personally, I invest about 10 to 20% of my entire Bitcoin portfolio in large market caps and top tier projects, and I leave about 1 to 10% for smaller average projects. There are many components to trade management. A good rule of thumb is to only take trades which have at least a risk to reward ratio of 1:3. This means that the potential profit of your trade should be at least 3 times its potential loss. In this way, you can lose 3 times, win once, and still break even over 4 trades. Don't overtrade, straightforward enough, and make sure to always cut your losses quickly and protect your profits. Most professional traders risk no more than 1 to 2% per trade. But for those of you who have smaller portfolios, you can be a little bit more flexible. Consider increasing your risk to maybe 5, 10 or more, 5 to 10% or more. But just make sure to never go all in on one single trade. And if a trade goes south and your plan turns out to be wrong, make sure to quickly cut your losses and never hold it longer than you should. This is where most traders make a mistake of being patient when they really should be acting fast. Let me just add 2 more important points about trade management. Sometimes when price breaks out of a pattern, people start chasing the price for fear of missing out. Let's take a look at this chart, for example. When this price breaks out of this inverse head and shoulder pattern, it is always better to wait for the price to drop back to around the throwback area here, because price will always retrace to the previous breakout point or to prior resistance, which is now formed support, similar to the chart on the right. And the next point is that the trend is your friend, and what this basically means is that you should only take trades in direction of the trend, only long or buy in a bull market and vice versa. If you own Bitcoin or are considering to invest in it, I highly recommend reading the Bitcoin white paper. It's only 9 pages long, and I think it is important that you attempt to understand what you're investing in and putting your hard-earned money into. If you're serious about trading and want to profit from it, you must do your own research. Read up and don't blindly follow other people's advice. Lastly, if you want to succeed long-term in trading, you need the attitude to want to continually learn and improve. It's important to be humble, or you end up becoming a hazard to yourself and your trading balance. To me, Bitcoin and blockchain technology is here to stay. I believe it will revolutionize more than just the finance industry. Some people compare this revolution to the internet, but I feel it's something bigger than that. I'm almost certain that Bitcoin is the future of money, so learn to trade so that you can preserve capital and acquire more Bitcoins. Money is just the first app. Decentralization is the main game here. It will challenge and completely change the fabric of society and its idea about not just money, but also democracy, capitalism, and the root of many evils that we have today. So I sincerely hope that you will continue to learn and contribute to this amazing ecosystem, because it's all going to be worth it in the end. Thank you.